Hello viewers and subscribers and welcome to today's video. In this video, I will be continuing with financial statement analysis, a topic I started in the previous video. Specifically, I will dive into analyzing the income statement and look at earnings quality analysis. Earnings quality analysis is useful for both investors trying to understand the quality of a company's earnings for a company that they're planning to invest in or they might already have invested in and is trying to make a decision how to handle that investment going forward. It's also important for business owners as it helps them to understand the quality of their company's earnings and whether that earnings will be sustainable in the future. I hope you find this video educational and informative. Let's get into it.
Now, just a short recap on the financial statement analysis process that we follow as the accounting analyst. There are 4 steps involved. We answer some relevant questions, we perform common size financial statement analysis, ratio analysis, and then we put it all together to sum up our findings from the previous 3 steps. I will apply these 3 steps to performing earnings quality analysis. Earnings quality analysis is used to gauge the quality of a company's earnings. It helps investors make investment decisions and helps business owners to know whether the business can sustain its profitability. Earnings quality. High quality earnings are from the core business and are sustainable, while low quality earnings are from non-core operations and not sustainable. First step in earnings quality analysis is to answer the relevant questions. And what are these questions? Source of earnings. Are earnings from the core business? Is earnings sustainable? Are earnings recurring or non-recurring? We look at earnings management. To what extent are earnings subject to management judgment? And are earnings converted to cash in a reasonable time? Those are the 4 questions we pose for earnings quality analysis, and we'll attempt to answer all 4 questions. First question, are earnings from the core business? Now, core sources of earnings include your normal sales demand for your product or service, pricing power, being able to change the price of your products, product mix, selling different types of products, and getting new contracts. These are all sources of earnings from the core operations of the company. Now you have another source of earnings which are from non-core sources. These are things which have nothing to really do with your core operations. And we're talking about things like foreign currency changes. This can boost earnings, lower taxes, lower interest expense, non-recurring income or expense, accounting changes, and also acquisitions, acquiring other company. These are all ways a company's earnings can increase, but it has nothing to do with the company's core operations and therefore not so much in the company's controls. Now here's an example of earnings that are coming from non-core sources. This is Walgreens Boots Alliance, the pharmacy company. And we can see that in 2022, this is from the company's financial statements. In 2022, the company had operating income of $1.3 billion and reported net income of $4.3 billion. Within that net income, though, is this other income of almost $3 billion in 2022, and it was $558 million in 2021. Now, what is this $3 billion? According to the company's financial statements, this $3 billion is due to the remeasurement of the company's previously held equity and debt investments in Village MD and Shields to fair value, and the partial sale of the company's equity method investments in AmerisourceBergen and Option Care Health. So the company basically had some investments in other companies, and it revalued these investments to fair value, and that resulted in a gain and an increase in the company's income. So this type of earnings is from non-core sources, and it's unpredictable. It's unlikely that the company will have this type of income again in the next year. So in analyzing the company's earnings quality, you would put this type of earnings in the low quality bucket, earnings from non-core sources, as this type of earnings is unpredictable. Next question is, are earnings recurring or non-recurring? Now, recurring earnings are from normal ongoing business activities. It's sustainable, and examples include normal sale of a company's inventories. These earnings are recurring and ongoing. Non-recurring earnings are earnings from one-time activities and are typically unsustainable. And an example is one-time liquidation of old inventories. So let's say a company had some old inventories sitting on its book. It might decide to sell them at a discount and get a one-time boost in earnings. But obviously, it's not going to have old inventories all the time to sell. So this type of earnings, it's non-recurring, it's one-off, and it's unsustainable. The next question is, to what extent are earnings subject to management judgment? Earnings management is where companies dress up the financial statements to show desired operating results. That is where companies might use things like aggressive accounting methods to make the financial statements look better than they really are in reality. All financial statements require some type of estimates and assumptions. Because estimates and assumptions have to be made, earnings are subject to management judgment because management ultimately make these estimates and assumptions. Opportunity for earnings management increases as the use of estimates and assumptions increases. Why do companies manage earnings? They might do it to meet Wall Street analysts' earnings estimates. Management might do it to achieve bonus targets or to present better financial results to investors, lenders, buyers, and other stakeholders. Now, a red flag for earnings management, a warning sign, if you may, is where a company consistently meets or just beats their earnings estimates. This could be a sign that management is doing something to just barely make these earnings estimates when they might have been falling behind had they not done anything. So management might just use accounting changes there, be a little aggressive in its accounting so that it can meet or beat its earnings estimates. So that's a red flag to look for when analyzing the income statement for earnings quality. Some items with significant estimates and assumptions and therefore prone to earnings management. These are things you look for in the company's financial statements. Under revenue recognition, if they have things like percentage of completion, gross versus net, multiple performance obligations, sales to distributors, which can lead to something called channel stuffing. These are things you would look for in the financial statements. Accounting reserves. Companies can create a cookie jar using accounting reserves, which they can then empty, quote unquote, in bad times to boost earnings. Accounting reserves are reserves that are set aside for when things go bad. For example, a bad debt allowance could be set aside for customers that don't pay in the future. And companies have to estimate these reserves. So they could potentially make this reserve too big. And in the future, when customers actually pay up and they don't have to use this cookie jar, they can then put it back into the financials and it actually gives them an earnings boost. You should review the reserve roll forward and schedule 2 in the company's 10K. Acquisitions, fair value estimates, allocation to goodwill, contingent consideration. These are some things that companies can use to manipulate earnings when they acquire another company. Things to look for when analyzing reserves. If reserves are falling as a percentage of the related asset, for example, bad debt allowance as a percentage of receivables, if this is falling too much, it could be a sign that the company is managing this reserve. Compute earnings impact if reserve as percentage of asset is lower than the prior year. Then you recalculate the allowance, assuming the reserve as a percent of asset is the same as prior year. The earnings impact is the difference between the recalculated allowance and the reported allowance. Another thing to look for when analyzing reserves is where a company is reducing its provisions when write offs are increasing. This means the company is reducing its reserves at a time when customers are paying less, and it therefore has to be writing off, more receivables. Provisions are less than write-offs. This is where the company is providing less reserve than the actual write-offs from customers. And these are some of the different types of reserves. Allowance for doubtful accounts. This is for receivables. Loan loss allowance. Typically, this is related to banks. Obsolescence or LIFO reserves. This is for inventory. Sales return allowance for revenue. Warranty reserves, again related to revenue. Restructuring reserves. Environmental remediation reserves, and contingencies. These are all types of reserve you will see in a company's financial statements. Let's just take a look at some things to look for when companies do acquisitions. These are things which can impact earnings quality. Large allocation of purchase price to goodwill. This means lower quarterly amortization expense. When a company acquires another company, it allocates a portion of the purchase price to what is called goodwill. Now, goodwill is typically not amortized, it just sits on the balance sheet. So, if a company puts more of the purchase price to goodwill, it will have lower expenses to amortize each quarter. Typically, the more goes to goodwill, the less goes to what is called other intangible assets. And these other intangible assets are amortized to expense each quarter. So allocating a larger part of the purchase price to goodwill means there will be lower quarterly amortization expense for intangible assets. Post-acquisition change in the purchase price allocation. Again, the company could change the purchase price allocation subsequent to the acquisition and potentially put more to goodwill and therefore lower its amortization expense, as I just discussed. And this may benefit earnings, for example, as I said, increasing the goodwill allocation. Contingent consideration. This could be a cookie jar if it's too large. Now, a contingent consideration is where a part of the purchase price is contingent on the company that is being acquired meeting certain performance targets in its financial statements. And if these targets are not met, the company that's buying this company could take back some of this contingent consideration and it goes back to its earnings. So a company might intentionally make this contingent consideration too large, knowing that the target will not be met, and then it can reverse it in the future and boost the company's earnings. And as I mentioned, post-acquisition changes in contingent consideration may benefit earnings. Next question, is the company converting earnings to cash? This is question 4. Cash is a company's lifeblood. A company needs cash to pay bills, fund operations, and it will go out of business if it is not generating enough cash. Slow cash collection could be a sign that the company is recording revenues too soon, aggressive accounting. The company may have to write off receivables if it cannot collect its cash, and this lowers operating cash flows. A red flag when analyzing the financial statements for cash collection is where operating cash flow is lower than net income. This could be a sign that the company is having trouble collecting cash from sales. It might be recording revenues too soon, and it could indicate poor earnings quality. Cash flows do fluctuate, but over time they should converge with earnings. You should review the liquidity section of the MD&A for what's impacting cash flow from operations. And MD&A is management discussion and analysis, and this is found in the company's financial statements. Earnings quality issues might exist if there is no reasonable explanation for differences between cash flows and earnings. Okay, so that was the first step, asking and answering those questions. The next step is to perform common size income statement. Common size analysis express financial statements in percentage terms. It's done over multiple periods, and there are 2 types, vertical and horizontal. Vertical analysis, income statement items are expressed as a percent of revenues, Balance sheet items are expressed as a percent of assets. For example, cost of sales falling as a percent of revenue. This could be a sign that the company is managing costs to meet earnings targets. And this is an example of a vertical analysis. Here we see sales and other items are expressed as a percent of sales. We start with sales, which is 100% of itself, 100% of sales. Then cost of sales, for example, is 64% of sales. So 180 is 64% of 280. And continuing like that down the line, here we see operating profit is 20% of sales in 2011. In 2020 it was 23%, and we continue down to where we see profit after tax. That's 9% of sales in 2011 from 8% in 2010. Horizontal analysis. Change in financial statement items year over year. For example, cost of sales increased over prior year. You'd want to find out what is causing this. Here is an example of horizontal analysis of the income statement. As you can see, everything is expressed as a percentage change year over year. So for example, sales increased 6% in 2024 from 2023, 265,000 in 2023 to 280,000 in 2024. We see that gross profit is down 11% from 112,000 to 100,000 on account of higher cost of sales and a slower growth in sales. Moving down the line, we can see where operating profit is down 8%, finance cost is down 71%, which is a pretty big decrease. And we can see that our profit after tax is up 14% from 22,000 to 25,000 in 2024. When you do the horizontal analysis, you'd want to examine the items that have significant changes. For example, you see your gross profit is down 11%, cost of sales is up 18%, your selling expense and admin expense are down 14%, finance costs down 14%, your profit is up 14%. So you want to examine these to see what is causing these changes, and that will help to guide your analysis on the conclusions you make. What to look for in common size analysis? Look for trend and relationship between items. For example, sales growth in relation to receivables growth. Is the sales growth keeping pace with the growth in your receivables? If that's not happening, it could be a sign that the company is having trouble collecting receivables. Changes in individual items, for example, inventory is increased by 50%. Again, you'd want to look to see what is causing this. Is it due to the company's business growing and therefore it needs to stock up on inventories? Or is it that sales are slowing, so inventories are not moving as fast as they should? Assess the impact on earnings, balance sheet, and cash flows from the findings from the common size analysis. Assess management explanations for reasonableness. Does what management says causing the changes make sense in light of what you're seeing? And here are some red flags to look for when doing common size analysis. If receivables are growing faster than sales, the potential issue could be that the company is recording revenue too soon, meaning that it's recording revenue before it has met the accounting criteria for revenue recognition. It might also suggest that the company is having collection problems collecting its receivables, and this could lead to possible bad debts. Another flag is if inventories are growing faster than sales or cost of sales. This could signal excess or obsolete inventories and put the company at potential risk of writing off some of these inventories. The risk is higher if the increase is in finished goods, because finished goods have probably a limited shelf life. So the longer you hold finished goods inventory, the higher the risk of potential write-offs and obsolete inventories and so on. Costs could possibly not be charged on some sales if inventories are growing faster than sales or cost of sales. Reserves as a percentage of assets increase. This could be that the company is creating a cookie jar, as we discussed earlier in the video about companies
setting aside reserves in a cookie jar to be used down the road. And if reserves as a percentage of assets are falling, it could be that the company is emptying a cookie jar created earlier, and this could result in an earnings boost. If long-term debt increases and interest expense decreases, the company could be capitalizing interest either inappropriately or maybe too aggressively. And this will give the company a short-term earnings boost because capitalizing interest means that it is not expense and does not hit the income statement. If operating expense as a percentage of sales decrease, it could be that the company is capitalizing operating expenses where it potentially should be expensing them. And again, similar to capitalizing interest, this would give the company an unsustainable boost in its earnings. So these are some of the red flags you can look for when doing common size analysis. Obviously, this is not an exhaustive list, and there are many other red flags that you look for when doing this type of analysis. And the red flags is a signal that something could be wrong. It could be that everything is fine, but you'd want to dig deeper into the financials if you see these flags and to make sure that management's explanations for these changes actually make sense.
Here's an example of a common size analysis on an actual company's financial statements. This is Vertex Pharmaceuticals. This information comes from their 10K for the year 2023, December 31, 2023 year end. And here we perform both vertical analysis and horizontal analysis. For the vertical analysis, you can see we express everything as a percentage of revenues, starting with revenue itself, which is 100%, and down to net income, which is 37% of revenues in 2023. And that is also consistent with 2022. So it didn't change actually. And then we have the horizontal analysis where everything is expressed as a percentage change over year. So the change in revenue, for example, is 11% from 2022 to 2023. Revenue increased by 11%. If we go down a little more, we can see where total costs and expenses are up by 31%. And to the bottom line here, where net income is up by 9% year over year. That is how you would set out your common size analysis in reality. This line here, I think this should be under revenues. I think we have it under costs and expenses, but this should have been under revenues. So here we see revenues are up 11% in 2023. I don't have that here, but it was also up 18% in 2022. So revenue growth is actually slowing in 2023. And in reality, when you're doing this, you should actually have at least 3 years worth of analysis here. But as we're just doing an example, we just do this for 1 year to show you how to do it. But typically you want to have at least 3 years to give you more meaningful information. Some of the other things that have changed significantly, we see R&D expenses is 32% of revenue in 2023, and it's also up 25% year over year. So this might suggest that the management is actually investing in the business, which is a good sign. We see where total costs are 61% of revenue, but it was 52% in 2022. So this tells us that the business is getting more costly to operate, and this could lead to lower operating margin. And indeed, we see that where the income from operations was 39% in 2023, whereas it was 48% in 2022. So that's your operating margin. So we can see where the increased costs resulted in a lower operating margin. And that's a pretty big drop from 48% to 39%. Other things we see happening, big jump in interest income. If we look at interest income, we see where that moved from 145 million to 615 million. And we picked up that by looking at the percentages. It
moved from 2% of revenues to 6% in 2023, and the year-over-year increase was 325%. So pretty big jump there, and this would tell us that there's a significant increase in the company's cash without even looking at the balance sheet. And you would want to investigate where that cash is coming from to see if it's sustainable or it's a one-off transaction that the company had that led to a big jump in its cash balances and its interest income. So then we get down to net income and we see where the margin was unchanged in 2023. It was still 37% of revenues. So given the big jump in expenses, in operating expenses, how did they manage to keep their net income margin consistent with prior year? Well, if we look at it, we can see that the big reason for that is that the company had a decrease in its, well, a couple of things. The company had a decrease in its tax provisions for 2023, where it moved from $910 million to $760 million in 23 from 2022. And also the jump in the interest income, that would also add to the bottom line. That's after the operating income dropped. So this offsets some of that. So these things, which are typically non-recurring, not items you can rely on to boost your earnings, these are what offset the increase in operating expenses and help the company to keep its bottom line consistent. So that is how you would perform a common size analysis. And as I mentioned earlier, typically you want to have at least 3 years of analysis to really understand the trend in the company's business. But that's how you'd go about setting up and doing a common size analysis. All right, step 3, ratio analysis. Ratio analysis, you examine the relationship between financial statement items. Examine the relationship between financial statement items. It's used to identify financial statement risks, and you should review large unusual changes or trends in ratios. For example, if days sales in receivables increased meaningfully for 3 years, then fell in year 4, you'd want to determine what caused that to happen and if there's something happening in the company's financials. Typically, falling DSOs means quicker receivables collection. It could be legitimately the company has been able to increase its receivables collection, but it could also mean that the company may have sold some receivables, or it might have moved receivables to another account, probably inappropriately. If the company sold receivables, for example, that may be excluded from DSOs. The point I'm making, though, is that there could be a legitimate reason for the receivables collection increasing meaningfully, or it could be that the company is playing around with the financial statement with the receivables to make it seem like if it's collecting receivables quicker in the normal course of business. So a significant change in a ratio like that, you want to investigate it to see what's really happening with the company. Receivables are usually sold at a discount, and the company could be on the hook for losses if receivables sold. Just continuing to talk a little bit there about the receivables. No real improvement in DSOs if receivables are sold or removed. Let's now look at the different types of ratios that we have. Asset liability turnover ratios. These measure how efficiently a company is managing its assets and liabilities. For example, days inventory outstanding, the number of days the company takes to sell its inventories. Days payable outstanding, the number of days a company takes to pay its creditors. Profitability ratios, these measure a company's ability to generate profits. For example, operating margin, which is sales less operating expenses. Then we have solvency ratios, which looks at the capital structure, that is the level of debt or equity used to fund a company's operations. And an example of a solvency ratio is debt to equity, which is debt expressed as a percentage of total equity. In doing earnings quality analysis, the key issue is whether operating results are from the core business and are sustainable. And
In this regard, profitability and asset liability turnover ratios are best for analyzing earnings quality. You should also perform peer analysis when doing ratio analysis. Ratios that are significantly different from a company's peers may suggest operational risks, or it could be that the company is managing the financial statements. And here are some earnings quality ratios and potential issues that they may be pointing to. Gross profit margin, this is a profitability ratio, and it's gross profit over revenue. And this tells us whether sales cover cost of sales. And a red flag is if this ratio is falling or is growing too quickly or is volatile. Operating margin, this is another profitability ratio, and it's operating income over revenue. And it looks at whether sales cover operating costs. And the red flag there is if it's falling, growing too quickly, or it's volatile. Cash flow to net income. This is both a profitability and a liquidity ratio, and it's computed as operating cash flow over net income. This measure tells us whether the company is converting earnings to cash in a timely manner. The red flag is if this ratio is below 1, and this could suggest the company is having collection issues with collecting its receivables, or it could be a sign of early revenue recognition. That is, the company is recognizing revenue before it has actually met the criteria to recognize revenue. Days sales outstanding, or DSOs, this is an asset turnover ratio, and is computed as receivables divided by revenues over 365. And this tells us the number of days a company takes to collect its receivables. If this number is higher, it means the company is taking longer to collect, and you should look for large swings in this number. This number should remain fairly consistent. So large swings, whether up or down, is a sign that something could be happening in the company. And this could include things like collection issues or early revenue recognition. Days inventory outstanding, or DIOs, this is an asset turnover ratio, and it's inventories over cost of sales over 365. And this tells us the number of days a company takes to convert goods to sales. Higher number means the company is taking longer to convert inventories to sales, and you should look for large swings, either up or down. Significant changes in DSOs could indicate risk of obsolete inventories, potentially leading to write-offs and lower earnings. That has taken us through the first 3 steps, and the last step is where you would put it all together. You would combine your findings from steps 1 to 3 and use this to assess the overall earnings quality. So taking everything you've done, putting it all together, tying it together, and this would give you an indication of the company's overall earnings quality. And that takes us to the end of earnings quality analysis. In the next video, I will be looking at balance sheet quality analysis. Let me come back on camera here for a minute. As you can see then, earnings quality analysis is very important in understanding a company's earnings and where it's coming from, and whether that earnings will be sustainable or is likely to be sustainable in the future. So as an investor, that's very important to you in understanding a company's earnings and whether you want to keep your investment in a company or start a new investment in a company that you've not invested in before. As a business owner, earnings quality analysis helps you to understand where your earnings are coming from and where you might have trouble in the future maintaining that revenue. So earnings quality analysis is a very important part of the overall financial statement analysis. And in the next video, we'll be looking at balance sheet quality analysis as part of the overall financial statement analysis process. Once again, thanks you for joining me in this video. Hope you learned a lot, and I look forward to continuing this journey with you. As always, please remember to like, subscribe, and share this video. And I will see you in the next video.